Hello and welcome to ETFatlas. My name is Jack Lempart and I'm delighted to be here with you for another episode. At ETFatlas, we host the world's largest ETF database covering funds from the United States, Canada and Europe. So basically, if you can't find an ETF on our platform, chances are it hasn't been created yet. And today, we're joined once again by Paul Merriman. And this marks a very special return to our podcast because, Paul, you were actually our first guest when we launched this podcast, when we just explored your journey from stockbroker to founding the Merriman Financial Education Foundation. And that conversation covered your philosophy on data-driven investing and, of course, on small cap value strategies. But today, I want to focus on something incredibly practical for our listeners: the biggest mistakes beginner investors make and how to avoid them. So, Paul, I believe this is a topic that's at the heart of your educational mission, and I believe it could save our listeners literally millions of dollars over their investing lifetime. So welcome back, Paul. And for listeners who might have missed our first conversation, could you briefly just introduce yourself and tell us what's driven your transition from managing wealth to educating investors?
Jack, it's great to be back, and I'm going to have to put the fact that I was your guest, the first guest on my site. So it'll be one more accomplishment that I had in my life. And when you get old, you got to keep track of the things that turned out well. The way I built my business was teaching, and I'm talking about the investment advisory business, starting in 1983. I taught people how to do everything on their own, so they wouldn't need to pay an advisor an outrageous 1% a year to have them do the work. Because as you and I know, when you can make an extra 1% a year for life, that's a life-changing for somebody, a life-changing impact. So when I retired in 2012, I stopped being an investment advisor and I was purely a teacher. So I really have been teaching since 1983, trying to help people get a better result for the risk they're taking with the investments that they make. Even if they don't do what I want them to do, what they do, I want them to do it in a way that's in their best interest. And I got to tell you, when I'm sitting here in front of the groups of people that you are servicing and talking with, I know that I have an opportunity to change a life. And that this is my fondest dream is that in this conversation, you and I will say something that will motivate people to move to action, to do something that's in their best interest. Because the bottom line is, at some level, we need to be good teachers. But you know something, we need to be good preachers as well, because it is one thing to be able to share important information, but can we motivate you from that conversation to actually move to action and have it impact you and your family? So that's my life is all about that. I don't care if we're talking about helping a newborn child and I'm trying to talk to the parents or the grandparents, or we're talking about somebody just coming out of high school or college and they're going to start having that extra income to invest. We want to be there to help you do it better. That's what this conversation is about.
All right. So let's make some foundation of investment mistakes we are going to cover during this discussion. And Paul, in your books, like We Talking Millions and also in your Financial Fitness Forever, you emphasize that successful investing isn't complicated, yet most people struggle with it. So what's the fundamental disconnect between the simplicity of good investing and the complexity that most beginners experience?
Well, there are really a variety of levels of challenges that take something that is very, very simple and make it more difficult. First of all, we're talking about your money. And what happens to your money is really important. And some people will watch that money every day and see how their investments are doing. Others don't even look. They're Rip Van Winkle, 20 years, no peaking. And the people who are peaking all the time are going to have their emotions probably wrapped up in what's going on in the process. That is a hurdle. Another hurdle, I think, is that the things that make investing work, that truly, if you look at the things that a path, a fork in the road, and you look at the right and the left, one of those ways is not going to be in your best interest, but it will look like it is going to be in your best interest because it is the intuitive thing you want to do. And yet so many things that really create a successful long-term investment process is to be counterintuitive. And so and this would be what Warren Buffett would certainly say in his advice, is that you have to be willing to invest when others are looking for safety. And I think the final thing that happens to investors when they started investing initially, they're in it for not only the fun, but for the opportunity to make money, to take risk, to manage that risk. They don't really want to be thoughtless about the risk. But the challenge really is that the success of long-term investment does not come from aggressive, exciting, fun things. It comes, believe it or not, almost 99% from being defensive. So almost anything on this conversation we have, Jack, at the end of each thing that I say where I'm trying to recommend something, I think if you look carefully, you'll say, yes, that is a defensive step. So between the emotional challenges and some of the ideas about what successful investing is about, offense, when in fact it's defense, those are important aspects of where people get it wrong.
All right. You've written extensively about how emotions drive investment mistakes. In your book, Financial Fitness Forever, you mentioned that investing is like dieting. In fact, like it's simple but not easy. Also, Warren Buffett says so, I believe. And can you please elaborate on this analogy and explain why behavioral factors are often more important probably than market knowledge for beginning investors?
Yeah, and let me give you the bottom line because it's a big bottom line. You can do everything right as an investor for a lifetime and just once succumb to the emotional aspects of the process and do something that in fact is going to cut your lifetime return in half. And so with that as at least that's what my belief is, and that's a big deal. That's, in fact, most professionals will say the two things that are killers over a lifetime are the expenses and the emotions. And so the complicated part about this is that you and I are sitting here, and I've talked with you enough times to know what you're trying to do in helping people. And that's what we're trying to do. We do not make a penny. We are a nonprofit foundation. I do not get paid anything for the hours that I put in, and neither do the engineers that work with me to give the information that we provide. But there is an industry that makes a fortune off of people if they can get their hands on their money. And so these people, in many cases, unfortunately, really don't care about your financial future. They care about their financial future. So they're doing what they can in order to get you to do the thing that will be to their benefit. And if you want to be the best that you can be, you need to understand the decisions that you make that are in your best interest. I can't say guaranteed, Jack. You can't say guaranteed. But what we can do that is as close to guaranteed as I know is give you information that says the probability of success of this step over that step is historically 99% to your favor. And if I could actually convince that, and that's not true with every step, sometimes maybe it's only 75% in terms of probabilities. But to get you to do the things that are probably going to work for you. And Warren Buffett has said it most simply. When his quote is, to be a success, you only have to do a very few things right. Very few things right. As long as you don't do too many things wrong. And so while I would love to be able just to say, do these 12 things, I know that if we don't introduce you to the 12 bad things that other people want you to do, that you may get sucker punched by them. And I want to do everything that I can. And I don't have long to do this as a teacher, but I want to do everything that I can to get you to be aware of the probabilities and to commit yourself for a lifetime to sticking along the path that is built to be for you, not somebody else.
Paul, I would like to walk through what I consider the most costly mistakes beginners make, the ones that can literally cost them millions over their lifetime. So let me ask you about each of these major pitfalls that you've identified through your decades of experience. So I just numbered them and I have 4 mistakes in front of me. And the first mistake I have on my list is trusting the wrong advice. In your recent writings, also in your podcast, you've identified trusting the wrong advice as potentially the single biggest mistake investors make. Could you please explain what the wrong advice looks like in practice and how beginners can identify trustworthy sources of information?
Well, the wrong advice is advice that has a low probability of success. And if you look at each of the important steps that you take as an investor, and I'm sure we'll talk about some of these during our conversation in more depth, but the bottom line is that if you take one path and it somehow costs you more than taking the other path, and in paying more, you are not likely or probably going to get more. As a matter of fact, it turns out that when you pay more in this particular industry, you are likely to get less in your pocket at the end of this process. So that big fork in the road is knowing what's the outcome likely to me, and then having the smarts. And this is not complex smarts, but knowing about the implications of long-term multiplying of compounding returns and understanding that just small differences in return over a lifetime can put a whole lot more money in your pocket. So if you come out of this conversation today, or because you read my free book, or however you come out of it, saying, there are some things I can do that are in my best interest. But what if you talk to a teacher, to a salesperson, and sometimes people can't tell the difference, but let's say you talk to somebody who says, if you take this path with me, you are going to make more money, even though you take higher risk, even though we don't use index funds, even though we do active management. There's a whole bunch of things they could say, follow me, I'm going to do these things. And I promise you They will imply or say that if you just do it with them, you are going to make a lot more money, because that is the promise that comes from Wall Street. And I think it is so important that you know the difference between the recommendations we get out of Wall Street, recommendations we get on Main Street. Main Street would be your neighbor or somebody at work who everybody thinks is the expert on investing, but they want you to follow what they are suggesting because they feel confident they got something they know about that you probably don't. But it could be very wrong. Now, at the end of the day, from everything I know about the past, and I mean everything I know about investing, if I had to pick a source of advice to live my life by as an investor, it would come out of the academic community, not Wall Street, not my neighbors. I don't even know if neighbors are telling me the truth. I was a stockbroker for a few years, back in the 1960s, a long time ago. And I want to tell you what they told me as I started my first week as a licensed securities salesperson. A friend that I had met there at the firm, older, probably in his 30s, I was 22. He said, I just want you to know a couple of things that are important in order of you doing well as a broker. The first thing is you need to create a sense of loyalty. Firing you as somebody's advisor or broker should be as difficult as kicking a kid out of the house. You want them to think of you as a dear friend and somebody to be trusted at all times. Now, the next thing he said is, and this will tell you right immediately that they weren't thinking about the client. The second thing is that when you're selling, the only time you're going to make a ton of money is when the market is high, because investors don't want to invest when the market is low. They want to invest when the market is up. And this is an emotional thing I'm sure we'll talk more about, Jack. But the bottom line is the advice that I got as an early broker, salesperson, was sell, sell, sell when the market is high. Because if you don't make a lot of money then, you're not going to make much money in this business. Well, in whose favor is it to have people load up on stocks when the market is high? Well, it's in Wall Street's best interest, but actually not in the investors, because we know that over time, it's the ability to get the discipline of investing when the market is down and dirty rather than when it's high and so exciting. So there's a start.
Okay, so now let's move to another mistake. Mistake number 2, I put on my list, starting too late. And in fact, in $12 million decisions framework by you, Paul, it shows that the first 5 years of investing can represent even 40% of a portfolio's long-term value. And for our listeners who might be in their 30s or maybe 40s, as I am, and feeling like they've already missed that boat, what's your message to them?
Well, you start and take care of what you can for the future right now. I mean, the old saying is the best time to have planted a tree is 20 years ago. The second best time is now. And the sooner you get to it and face the fact that you're behind, which obviously means you've got to be a more aggressive saver. That's one of the beauties of starting when you're young. You aren't forced to oversave when you get older. But if you don't, you're very likely going to have to be very aggressive at the very time in life when it's going to start like feeling like you've got more to spend. So, and remember, I mean, this is a real challenge in terms of a mistake. Most of the world wants you to spend your money. Most of the world does not want you to keep your money in your pocket or the stock market or the bank. They want you to be spending because that's what benefits them. So you need to be get to work now. And you're right, Jack. That first 5 to 7 years, this partly has to do with that rule of 72. That rule of 72 says if you divide the return into 72, and then that would be 12. 6 times 12, 72. That's how many years it takes to double. So if you, for example, were making 10% on your investments over a lifetime, and you start 7 years late because it will take 7 years to double, that means that if you have that extra 7 years tagged on to all the other years, that you're going to get one more double, maybe. I mean, we never know for sure, but you could. As a matter of fact, a person who started early happened to start in 1995 instead of waiting till they were 30, let's say. They started when they were 25 in 1995. That first 5 years, the market compounded. I'm talking about the S&P 500, compounded at 28.5%. You missed it. If you weren't in it, you missed it. And they say, yeah, but wait a minute, the market also could have gone down. Yes, it could have gone down. And if it had gone down, that would have been good too, because those early dollars invested in the market, and I'm not talking about investing in an individual company, but a mutual fund, broadly diversified, that extra money going then would mean you're buying lots of these cheap companies that are going to eventually, likely, maybe, probably are going to grow and grow and grow. As a matter of fact, the average 40-year return of the S&P 500, and I know that's not the only investment people should own, but I can tell you that the average from 1928 to now is an 11% compound rate of return. That's the average. Now, it's been better and it's been worse. It's been 12.5% and it's been 8.9%. That's the best and the worst, but the average is 11. So the sooner you get started, the more likelihood that you're going to have another double in your life. And that another double can mean a big difference in your retirement. The difference between retiring with enough and retiring with more than enough. And I will tell you, having been around this business as an advisor since 1983, the people who retire with more than enough are the people who have the least anxiety about their financial condition. And when I look at what they did, the people that had more than enough, it wasn't that they found a great stock and they got on board and that's where they got more than enough. Typically, it's an engineer who understands the implication of numbers and statistics, and that simply put money away every month into a 401k. That's where most of the multimillionaires come from. And in most cases, what made a difference was starting early.
All right. So let's move to mistake number 3 from my list, which is letting emotions drive decisions. We already touched a bit about emotions, but my question is, what are the most common emotional traps you see beginners fall into, and what maybe practical systems can they implement to avoid these pitfalls?
Well, let me tell you what I think they need to do to avoid the pitfalls. They need to read the $12 million decisions, because those are built to help people avoid the pitfalls. But here's what we see with young investors. They don't know much about investing. They know that some people have gotten rich investing. And when they think about who those people are, they're probably people who invested in NVIDIA early or people who invested in Microsoft, certainly in Seattle, Washington, where I was for many, many years. There were a lot of people who invested early in Microsoft. In Atlanta, it was Coca-Cola because Coca-Cola was in Atlanta. So, yes, there are people who have the good fortune of having to live someplace where a company rose from the ashes and made a lot of money. That happens. And people picture themselves because it doesn't look very hard from afar. You can just simply look at what the market's been doing. And the first trap that happens to them, this is just a bias that we carry. And there are about 48 biases. And don't let me forget, Jack, to mention where they can get a little information on those 48 biases. But those biases are natural. They are something that you were born with. They are part of what they call the lizard brain at work. This is not your best thinking. Or if we talk about thinking, there's thinking fast and thinking slow. First time investors are very quick to make decisions because they have the help of their senses. They can see how you do it because here's a stock that just made a ton of money. Here's a stock that went down and lost a bunch of money. Don't want to be in that stock. I want to be with what's moving. And we think linearly. If something is going in a direction, we do have a sense, and there are lots of studies that prove this, that we do have a sense of what's going to happen next. And so even if it's something so simple as flipping two heads in a row, believe it or not, more people than not believe the next one is going to be a flip of another head. And so that trap of what is a combination of thinking it's all very easy and what they call the recency bias. And that is that those things that happen more recently are way more important than the things that happened 60, 70, 80, 90 years ago. And that's not true. If you want to learn lessons, real lessons about investing, you look at the returns. In fact, we make that easy. We have a quilt chart that, and I don't know if you can link to it or not, Jack, but I will tell you, it will let you see 1 year at a time. How did the big companies do and the small companies and the value companies and the growth companies? And you're going to see a history of investing where you will, I think, conclude as I have, is that there really isn't any pattern. I can't spot a pattern that would make me money. Now, having said that, you're going to learn about something that should make you more money, but you're not going to see that pattern easily in that quilt chart because it's a random event. And this is the part that people just don't get, is that investing is highly random. As a matter of fact, out of all the public companies that have gone public in the United States, that's all I know about in depth in this way, half of them didn't make any money. Some of them basically broke even. Many of them went bankrupt. And it was the other half that really accounted for the return of the market. Beyond that, 96% of those that have succeeded and been around, 96% have averaged a 3% compound rate of return. The other 4%, 1 out of 25, has averaged about 14% compound rate of return. It's that 1 out of 25 that has made the difference. And here's the problem. The academics have looked at this every way they can, and they do not have a way to identify those 1 out of 25. Oh, they do have ways to show you how to do better than the S&P 500 over a very long period of time. But even then, what you're going to see is something that takes a lot of patience to have it develop and pay off the way that the market can over the long term. And Jack, that's one of the big problems. Not only are they wanting to find ways to get rich, they want it to happen now. And successful investors rarely get rich now. And the ones who are trying to, and this is a lesson we should all learn, the ones who are literally trying to get rich now are buying lottery tickets because somebody is going to get rich now in the coming weeks, more than likely. But the odds against it happening, well, in the U.S., in the Powerball, I think it's about 300 million to 1. And that's not the kind of probabilities I want on your side. And so this desire for it to happen now, the desire to get rich soon, and then to believe the person with the best story. When I was being taught to be a stockbroker and taught how to sell, what they told us, and they still tell people, people do not buy the steak, they buy the sizzle. They buy the smell. When you walk into a restaurant, they want that smell of steak in your nose when you walk in, and you hungry for that taste that goes along with that smell. And everybody, and this is where I differ from so many, let me say the majority of people believe that the way you convince people to do something is tell them a story. And from my viewpoint, the story that I want you to know is the story of the history of the numbers. And by the way, I teach it to high school kids. This is not something that is difficult. You just have to look and have a teacher walk you through the numbers that at least they perceive to be important. Because I know if I understand what Jack is trying to do with his work and what I'm trying to do with my work, is I'm trying to teach people to be their own investment advisor so they don't ever have to pay somebody 1%. And if you learn how to study Jack's tables, you can learn how to find investments that have performed well for very long periods of time. That's what all those numbers are for. And the problem is, this is not necessarily easy or simple, is what I think you need to understand are all of the highlights of what a good advisor who would tell you what to do. If you're going to be a do-it-yourself investor, you are, in essence, an advisor, and you have one really important client, and that's you. And so you need to have the information that an advisor knows. So an advisor knows if you pay a load to buy a mutual fund, that money is gone forever for you, gone forever, and have gone forever in theory into the pocket of the salesperson. If you overpay in expenses, that person who's advising you knows what that means to them and the industry rather than to the investor. So all we want to do is to get you, again, just like when I started about those forks in the road, make sure that what you are advising to yourself is what a fiduciary would advise to an investor. And a fiduciary has a legal responsibility to tell the investor what's in their best interest. And that's what you want. Whether you get it from me or you go to our website and you see the other people that I think are smarter than I am in terms of teaching, so that you do get the information. And again, what Jack is putting together with his ETFatlas is the ability to study the past without being told a story, because you want to understand that some of those numbers, and this is a big item in terms of something young people don't get, there's a return that we can look at and say, whoa, wouldn't I like to have that? But the question is, good, that's a great return. What's the risk in that return? Now, I know, for example, that if you had all your money in high tech, the NASDAQ in the US, that would be the NASDAQ index, mostly is driven by high tech. So is the S&P 500 driven by high tech much of the time, not all the time, but much of the time historically. What do we know about high tech? Technology stocks, from time to time, as a group, lose 80%. Now, are you ready to lose 80%? And how do you not know whether or not the right now is the time that those stocks are going to go through one of those serious declines? Now, you might say to me, that's okay, Paul, because I'm going to be putting money in every month into that mutual fund that holds all those high-tech companies. So when the market's down, I'm going to keep buying. And if it keeps going down, I'm going to keep buying all the way down until it's down to 20 cents on what it was originally. But boy, I've got a big pocket full of those technology companies now, trusting that market is going to turn around and go back up. The problem is that many of you, if not most of you, along the way somehow lose the trust that they're going to recover. And so you bail out. You bail out, and you, in essence, leave on the table all of the hard work you put into that money that went into those stocks at lower and lower prices, because now you believe they are not going to exist any longer or ever sell for more than they sell for today. Well, let me just tell you, if you take the time to study the market back to 1929, we go back to 1928, you will see you go through some real bad periods. 10-year period, 29 to 38, 2000 to 2009. They both went down the same amount, almost exactly the same amount. So whether you were born or started investing in 29 or 2000, you just walked right into a terrible buzzsaw. But guess what? Following that period after 1938, the market was great, even though you walked into a war. And that's another problem that young people have. They start thinking that because there's a war going on, I don't want to be in the market for the long term. Because there's a politician I don't approve of, I don't want to be in the market during that politician's tenure. Or you might even say, I don't want to be in the market when it's going down. Because a lot of people will actually say, when you work with them, you talk with them, I don't want to lose any money. Well, I guarantee you'll lose money in the stock market. Not all of it. Now, if you want to try to buy individual stocks, and a lot of young people do that, you can lose it all. There are a lot of people who put money into cryptocurrency, but not Bitcoin. And I think there are some 1,800 different types of cryptocurrency. Many of them have gone out of business. And people are looking for that cryptocurrency that's just getting started and they want to get in on the ground floor. That is not investing. That is speculating. It may not be gambling, although it starts to look at it when you look at the outcome, because at the end of the day, I suspect that more money is being made for the majority of people on being, in essence, the broker who's doing the transactions. And that's where the money is, not in these unknown cryptocurrencies. Anyway, sorry to get off on all those, Jack, but I mean, Emotions are just huge, and I think I know how to help people control them.
But that's a good moment as well, Paul, to ask about another mistake, which you already touched a bit, which is the performance chasing, also in the case of maybe cryptocurrency. So my question is there a way, or what's the best way to help someone break this habit of, performance chasing?
Well, there are two reasons for performance chasing, I think, big ones. One is this recency bias, and the sense that you can get on board and ride that train home and, make a whole bunch of money. And the other is Wall Street sells performance. They talk about performance like 5 or 10 years is a big deal. For example, when the S&P 500 from 1995 to 1999 compounded at 28.5%, when people were surveyed and asked, how do you think it's going to do for the next 10 years? The average return that people believed was going to happen for the next 10 years was believed between 20 and 30%. And that's what Wall Street wants you to believe. Because if you believe that, you're going to put your money into those kinds of investments. Merrill Lynch, and I think it was 2000, came out with two high-tech computer kinds of mutual funds that sold huge amounts to the public and then turned right around and went down 80%. It's always more easy to sell what's done well for 5 or 10 years. But that's because people don't know. In fact, you're a professional in this sense. I don't mean you're a professional advisor. I don't think you hold yourself out as that, but you certainly understand statistics. How many years would you think it would take before you would believe that what you're seeing has some implications for the long term?
I would say decades you would have to take into account.
And people like Fama in French, the people who are so famous from the academic community in the U.S., they would even think that 30 years doesn't necessarily tell you the story. And by the way, one of the most profitable investments I know historically has, over the last 90 plus years, had 4 periods that had underperformed the S&P 500 between 15 and 20 years. And yet at the end of these longer periods, it was an amazing asset class as a group, just as the S&P has been an amazing. But you just got to build your portfolio and understand that people, and I think really at the end of the day, what you need to do, and everybody I know that's in my position as a teacher believes this: automate everything you can. Automate the day that the money goes in. That's easy to do if you're in a 401k or some sort of a regular retirement program that people around the world are putting money away in every month. So you're dollar cost averaging. You're not trying to guess whether the market is high or low. You're forcing yourself automatically to buy more cheaper shares when they're down, forcing yourself to buy fewer shares when they are up. And if you're doing that right, you're not counting on one company to do it. You're counting on hundreds, thousands. My wife and I have 12,000 stocks in our portfolio. You can recreate that portfolio with $100 investment. You too can have 12,000 companies. And what are you doing? You're getting automatic diversification, massive diversification. Consider the free lunch. The only free lunch of investing is diversification. And the more you got, the better off you are. So the more you can automate and just have things just happen without you letting your emotions have any part. I didn't even look at the end of last year to find out how did I do. It doesn't matter how I did last year. I didn't have any. I mean, if it was a good year or a bad year, it's nothing I did. And whatever it was last year doesn't have any impact on this year. I've got half my money, equity money, in internationals. And I have for many decades. And internationals have not been very good. Why didn't I get rid of them? They've been such dogs. Because I don't know when they are going to perform well. This year, I get phone calls and emails. Paul, should we be going into internationals? No, you should have had internationals when nobody wanted internationals. Now, that's maybe a hard thing to believe because, again, you only want stuff that goes up. And what I want things that go up for the long term and that there's a long history of that. Knowing that it may be a very long term before they, in fact, do not give me the return that I want. You invest in technology in 2000 in the US. I don't know about international, but I'm going to guess very similar. It took 15 to 16 years to break even. And even say, oh, well, I'm making money now. Well, you're not making money now because you've just been eaten up with inflation for 16 years and you didn't make any money to try to counteract that inflation. You have not broken even. But that's okay because when you're in the stock market, sometimes you have to wait a long time. But here's the good news. There were equity asset classes that during that period of time made lots of money. You would have been so thrilled to have them in your portfolio. But guess what? They didn't do so well the previous decade or so. So quit thinking you're going to find financial nirvana and get on the market that has the probabilities working in your best interests. Remembering, I think, one very important thing. Whatever the market is doing, if you're investing properly, at least through my eyes, you own some of the most amazing public companies. And some of them will become even more amazing, and some who are not amazing now will become amazing. I mean, they're going to be all over the place. But at almost any day of the year, if I could walk in and get an hour with the president of that company, and they told me about their company and what they're doing for the world and what their plans for the future are, I promise you that almost every one of them would sound like a good opportunity for the long term. Except when you go into one of those companies and you say, you know something, the president says, I don't know what to say. We've really been under fire. We've had trouble with the unions. We've had trouble with the government getting some things approved that are important to us. I don't know. Things don't look so good. But the one thing I can tell you that's also kind of depressing is the price of the stock is way down. Now, having said that I'm discouraged about that, let me tell you what we plan to do to turn this company around. Because that's what those small value companies typically are. They are companies that somebody is going to figure out how to turn around. And people will work amazing overtime to do it. You don't have to work overtime. Let them work overtime. You're the investor in these companies. And I think genuinely, if you had that hour with the CEO or the president or the chairman of the board, you'd be happy that you own part of that company.
Paul, by the way, you mentioned about US stocks, which were underwater for about 15, 16 years. Here in Europe, there were countries like Belgium or Austria, which in real terms were underwater for like 80, 90 years, almost 100 years. Just a single country stock markets was for such a long time underwater. So that's also maybe something which should convince maybe our listeners for broad diversification. And I wanted to discuss now shortly another topic, which is complexity trap. You mentioned about keeping things simple, but we have thousands of mutual funds. We have thousands of ETFs. Just on ETFatlas, we have over 11,000 ETFs. Of course, these are not only from the United States, because we have also Canadian and European, but still it's over 11,000. So beginners often feel overwhelmed by this huge choice. In your book, Financial Fitness Forever, you advocate very often for simplicity. And how should a complete beginner approach fund selection or ETF selection without getting paralyzed by options?
Well, let me, if I might, make a comment about today versus when I went into the industry. Investing has never, ever been as efficient as it is today. When I started in the business, mutual funds had an 8.5% commission to buy. They had expenses that were high. There was no index fund. There were no target date funds. Do you have any target date funds in Europe yet?
Yes, we do have. They are maybe not so popular yet, but yes, we do have them as well.
And of course, we didn't have ETFs either. I mean, and ETFs are an amazing investment. Not only do you get the diversification, but you also get a tax efficiency that you cannot get with a traditional mutual fund. Now, I don't know if that's true in other parts of the world, but it certainly is here in the US. So remember that as far as I'm concerned, anyhow, if you followed my path as an investor through my life and did the same thing, you would make a lot more money than I did, because I didn't have access to that kind of efficiency for most of my life. And by the way, the other thing is we didn't have all the academic research that taught us about big and small and value and growth. They didn't teach that when I was going to the New York Institute of Finance in 1966. But the academics changed our understanding of what kinds of investments work and what kinds don't work for the long term. Now, with all that as an introduction to where you are now, you're in the catbird seat. If you just figure this out, it's never been as good for you as it is today. Again, I don't know about the tax-free investments you have, Jack, but the Roth IRA and 401k, the fact that we can have it compound tax-free all your life, and then you take it out tax-free all your life, then you leave it to your family for 10 years, and they can take it out tax-free for 10 years. So that is just amazing. What else has happened that is amazing, I think, and it even relates to that Financial Fitness Forever that I wrote back in about 2011 for a TV special that PBS, Public Broadcasting Company, ran across the country as a way to raise money for PBS stations. We didn't have ETFs, and I didn't have a simple strategy. I had a strategy where, in order to get properly diversified, you had to buy 10 to 13 different mutual funds. And then in 2017, An engineer, retired engineer, came to work with us. He retired from NVIDIA and one of the smartest, nicest people I've ever met, Chris Pedersen. He took the time to take that 10, 13 fund strategy down to as few as 2 funds. And so with 2 funds or 4 funds, you really don't need any more than that. You can have a portfolio that is diversified between big and small and value and growth and US and international. And so people have learned how to make the process simpler. And mutual funds are trying to compete with, in essence, that investment advisor. And the investment advisor wants to take the responsibility of working with you to tell you how much you should have in stocks and how much you should have in bonds. And the mutual funds have now developed these target date funds, making it simpler because they will do that for you for the rest of your life. And then we have robo-advisors today who will do what you need to for the rest of your life. They're going to charge you. Not always, by the way. When you're small, they might do it for free just to get you hooked. But the bottom line is you need to know enough to select a handful of these 10, 20,000 funds and individual stocks. You add that to the pile of things you can pick from. Now, what we do is we go through all the ETFs and pick out the ones we like best. If you want to be in small cap value, we'll give you a few of what we think are the best. If you want to be in large cap growth or blend, then we'll give you names that we think are amongst the best, because you can't know the best. So that is happening online. That kind of advice is online. And what Jack is doing with, in fact, Jack, I just want to take a second and ask how much you do in terms of you being able to give people a portfolio that they can put together on their own. It would be helpful for me to understand how far you are going in helping people to select the ETFs that they could use in building a portfolio.
So first of all, we know that because we have so many ETFs, like I said, it's over 11,000 ETFs just in ETFatlas. We do prepare kind of rankings where we just put, for example, ETFs for S&P 500 or ETFs for small cap value, where you just see the whole list so we can easily compare them within the same group. So this is the first thing. Another thing is that we also use what is called Morningstar rating stars. So basically, you can select among specific ETF groups the ETFs which are highly ranked by Morningstar. They have a special ranking system where they look into the past even 10 years of the performance of the ETF, but not only on the performance, but also on the risk. So it's a risk-adjusted ranking. So also we have this system which allows people to take, let's say, smarter decisions, not only looking only on the return, but also on the risk side. And on top of it, we are currently working also on a backtesting system, which will allow to, maybe for the beginners, even it will be easier because we will put a bunch of portfolios which are ready to use, or it's like an example which you can follow, where you can see how it performed, not only within 1, 2, 3 years, but also in terms even of 100 years. You can see how it performed, how it's risk adjusted, how it's inflation adjusted, how it performed when you were in the accumulation phase, when you were adding money into it, how it was behaving when you were already retired, when you were withdrawing money from out of this portfolio. So this is the tool which will be available in the coming months. But all in all, what we do is to provide people tools which will allow them to take data-driven decisions. Because, as Edward Deming said once, that without data, you're just another person with an opinion. So we just want to make people taking decisions based on the data, also based on the academy. For example, my next interview will be with Larry Swedrow, which is really also among the list of the truth tellers on your site, Paul. And we are trying to follow these best examples, best rules to teach people based on data. And of course, everyone can have an opinion, but it's good to have an opinion based on data rather than out of the blue. So that's what we are trying to do here.
And just one last question from me. Do you have our portfolios on your site so that people, if they wanted to, could test those?
We do have it, although it's not yet built into the website. It's a free tool which is in the form of the Google Sheet, and there you can already have access to a simple simulator where you can also simulate portfolios in the last 100 years. So it's free. You can just visit our website and you can start using it. It's absolutely free tool. But we know that the Google Sheet is maybe not so intuitive or so easy especially for beginners. Therefore, we are working on something which is even better, which is directly built into the ETFatlas, and I think it will be even easier to use it.
That's wonderful. I'm happy to hear that people can access our portfolios there. Everything we do, by the way, is almost everything is free. There are a few books that we can't provide free that are available at Amazon. But then we have a lot of other books that are free, and our portfolios are everything we do is meant purely to educate. And as I mentioned, we're a nonprofit foundation. So where were we on your questions?
Well, I think that because I have really a huge bunch of questions and topics about these mistakes. So another topic on my list is high fee trap, because this is, I think, really important thing to talk about. And especially in your $12 million decisions book, you identify fund expenses or investment expenses as a critical factor. So maybe, Paul, you could walk us through a real world example of maybe how paying, for example, 1% versus 0.1% in annual fees impacts a beginner's long-term wealth.
Yeah, I think that's really a big deal, and it seems so harmless. If I, for example, held myself out as the investment advisor who would help the first-time investor with their first $100, and I worked for them for a lifetime. And let's say I charged 1% a year for that service. And let's say that advisor over a that investor over a 40-year period put away $6,000 a year. And let's say they did that for the 40 years, and they made, let's say, 9%. And I took my one, and they netted out 7. So we then go into retirement, and I have to change it a little bit because we need to get more conservative in retirement. And not only do we get more conservative, but we need to take money out. So we take out 4% a year, and we make 6% gross and 5% net because of my 1%. And we do that for a lifetime. And I am sure that the person who looked at the bottom line numbers that they would receive for that return and taking that money out over their retirement would be very pleased with the outcome. They would say, my advisor did a great job. The fact is, from that when I say lousy $240,000 investment, I would get paid $3.5 million. $3.5 million. So when I tell you that I would like you to be able to do this yourself and not have to pay a professional advisor, then you're talking about potentially keeping that $3.5 million in your family. And it's not just your generation. I'm always thinking in terms of multi generations in the work that I do. So that means it was more than 3.5 million, because something's going to happen to that 3.5 million that wouldn't have happened because you had it and could make it happen. So, boy, there's a lot of motivation to be able to do that. And expenses are the easiest thing to be able to identify. And John Bogle makes a great point. He says market returns come and go, but expenses are forever. So if you can find any way to either add even 0.5% or 1%, or save a half, if you can make it or you can save it, any way you can get it extra is a big deal. I mean, for example, if you looked at two investments and one had a history of 5% and the other had a history of 10%, guess what? You are talking about probably a 12 to $20 million difference over time. I mean, it depends on how it happened and how many years it happened and all of those things. But I'm just saying that even 1/10 of 1% is worthy of note. So I am hot on the path. I get up earlier in the morning than most of you. This morning it was 2. Usually it's between 3 and 4. And part of what I'm getting up to do is see if I can find an extra 1/10 of 1% somewhere so you can change your financial future.
Paul, thank you for that. So let's move on. I know we are already talking for like more than an hour, and I still have this list here pretty long. I wanted to talk about asset allocation because many beginners either take too much risk, like for example, they put 100% stocks, or maybe too little risk, like mostly bonds, fixed income. How should someone in their 20s, 30s, 40s, maybe 50s think about the right balance between, this growth and protection on the other side?
So I think it's important to begin by thinking in terms of investing $1 million, not 100. I don't want you to wait to invest the $1 million because that could take a long time to save that. But what I want you to do is invest as if you had $1 million, because that is the whole idea of a diversified mutual fund, is that you get treated with $100 just as if you put in 10 million. So that is one of the real advantages of the mutual fund. So then the question is, if you're going to put the money into a mutual fund, how much of it should go into stocks? Now, I said how much because when you look at the difference between putting money into bonds and putting money into stocks, the difference is huge. And so I want the growth for you. Now, here's what is interesting about asset allocation. We have information by the month going back to 1928. And Jack, it sounds like you have information going back even further than 1928. And what we know is there are periods when very large companies they're doing great. And there are times when they are doing terrible. and smaller companies are doing great. And so what the academics taught us that was such an eye opener, and I didn't know about this when I was 22 years old and going into the business. Nobody talked this way. What they said in 1966 was if you wanted to be properly diversified, you needed to have 10 to 20 stocks in your portfolio. And then we learned later that really we needed to have at least 100 of any particular type of stock, large, small, value, growth. And then what we found out was that these large, small, value, growth, U.S. international, they don't go up and down together for some, let's call it unknown reason. Now, afterwards, we always know the reason, or even if we don't, the industry will make it up. So there will be a reason found. Why did that kind of stock do so well? Because sometimes investors don't want to pay any more than 10 times earnings for a company. And another time, they'll pay over 30 times earnings for a company. And part of that's based on the earnings of the company and how solid they are, what the future looks like. And part of it is just about the emotions. Right now, there's a really interesting thing going on with young people. It bothers me a lot, actually. And that is that they have really become aggressive in their investing. They are willing to take phenomenal amounts of risk in order to succeed. And the academics will tell you that there's nothing new about that. But what is also old about that is those things that perform amazing returns that a lot of young people are chasing. And it goes beyond just investing. It goes beyond speculating. Gambling is out of control in the U.S. now. I don't know about in Europe, Jack, but in the U.S., it's set up so that anybody of age, I think it's 18 probably, not sure, can gamble on sports. And a ton of money is being spent, so easily. It's like having your own a slot machine in your house, and you can pull the handle as often as you want. And so this has changed a lot in terms of how young people are investing. And they're doing a lot of things that all of the research says, based not on the last 100 years, but the last 500 years in some cases, that you're doing things that the probability of success is just so low, like meme stocks or like Dogecoin, which was a joke. It was done as a joke, and somebody was clever enough to turn it into real cryptocurrency. Well, it's still a joke, but somebody is making money off of people who will probably be made a joke of as an investor, as happened with Beanie Babies. I mean, it bothers me a lot because those early years we talked about early in this conversation, boy, you don't want to screw those up because those are the years that you can invest more aggressively, but intelligently, smartly, and gambling and speculating is not it is not considered to be an intelligent thing to do. Do we understand why you do it? Yeah, we do. There's a lot of how people live as young people today that are very different in terms of security. I do believe at age 22, I had a lot more security than 22-year-olds have today. That's just a major change in our society. But the bottom line is that you can mix up your portfolio with asset classes that over the long run have done amazingly well. I know when I talk to college kids, and I talk to a lot of them, I teach college classes, university classes here in the United States. And when invited, I'll do a Zoom presentation almost anywhere where I have a chance to educate people. And what I find is almost all of them say, yes, I would be happy with a 10% compound rate of return in my equity portfolio for the rest of my life. Well, that is not a difficult thing to do. But once you get to 12, once you get to 14, once you start thinking about trying to get 20 or 30, and by the way, lots of people make a 20% compound rate of return. Lots of people make a 30% compound rate of return. I invested a few $1,000s in an investment advisory firm in 1983, and it made over a 30-year period about a 30% compound rate of return. Now, the good news is that's a great rate of return. The bad news is I didn't invest very much. So the pile of money wasn't as big as it could have been, but it doesn't change what I did. I ran a company from nothing up to where we were managing about $1.6 billion. And it was a profitable business because you're charging people 1%. Now, I don't feel badly about that because I taught them how to do it free. And they chose to hire me instead of doing it free. So I always felt okay about that. But the bottom line is that if you diversify, just like the rich people are now diversifying, because the academic community was where they found out about the premiums for smaller companies, the premiums for value companies that are out of favor, the premiums for stocks over bonds. Believe it or not, in 1926, people believed that stocks were just a speculation and that bonds were the only real investment. So the fact that things change over time and that we learn new things is not surprising. But you have that ability to diversify. And that, of course, again, Jack, when you show them all of these different equity asset classes, and I suspect I'm curious, again, here I am asking you questions, and I apologize, but how many different equity asset classes do you, in essence, show them?
Actually, we have everything what is covered by Morningstar. So basically, I cannot tell you a number now, but basically, whatever is covered by Morningstar, we show it there because we have the full license for it. So I think that everyone will find a good portfolio, something which will be really fitting to his or her requirements will be there.
And if you want 1% in cryptocurrency, you can put
Also,
some money in an ETF cryptocurrency.
Yeah, there are also cryptocurrencies. So even if someone wants to invest in uranium, he can do it. So really, very, very crazy stuff. Everything is there. I mean, still, I think that maybe it's better to have some portfolio which is having a solid foundations. But if someone is looking for small percentage of cryptocurrency or something else, yeah, we do cover it on our website.
And that question about whether it makes sense to suggest people should be able to have some money to have some fun with, I'm all for it, except that I would like you to have a great time with a percentage of your money that you know for a fact you're not going to need later in life. If you know for a fact you got more than enough with what you're doing and the strategy you put together, and you're maxing out your IRA or your 401k or whatever that retirement account is called, I'm all for having fun. But I'm not for having fun if you aren't putting enough aside to be able to retire when you want to retire which means you got to figure out what that means, because you got to take a little time out of your life and put together a plan, which of course a lot of people don't want to take the time to do that. And yet every study we know shows that people who have a plan are more likely to meet their goals that they set than if they don't have a plan.
Paul, today's discussion is mainly about beginners' mistakes, but I wanted to ask you a question about so-called equal weighted indexes, because when we talk about the equity portfolio, by default, we think about cap-weighted indexes. So if we buy S&P 500, it's a cap-weighted index where basically the top 10 holdings in that portfolio, in that index, they make like 30% of the whole portfolio. Whereas in the equal weighted, each company has an equal weight in the portfolio. And I wanted to ask you about that idea. What's your take on it? Because you had a wonderful podcast episode recently about it. If you could quickly summarize the findings about it.
Well, let's just assume that we think about what the academics have told us about premiums. They tell us that small companies make more than large companies over a long period of time. And they have, if you look at all the public companies. They also tell us that companies that are out of favor make more money than companies that are in favor. And the reason that is probably true is because, one, stocks very often, companies get oversold. People don't want to be in that company because it's a dog. It's not very exciting. Doesn't have a huge future. So people won't pay much for it, and you can buy some bargains. So if companies that are small and out of favor, value companies, make a better return than large, if you in fact build the S&P 500, where every company has the same percentage in the portfolio, you got 500 little tiny pieces of these companies. And so if NVIDIA makes the most money, doesn't matter. Microsoft's making great money, doesn't matter. Apple's making, that doesn't matter. They are treated just like the smallest amongst them, the most out of favor. So theoretically, if the academics are right, if I build a portfolio with all of them the same amount, equal weighted, it should give me a better return because the average size company is going to be smaller, and the value orientation, there's going to be more value in the portfolio than in the growth driven, what they call cap weighted, where the bigger companies represent more of the daily value going up and down. So if we look at the S&P 500, according to Morningstar, there's a fund that has done that. And if you look over the last 25 years, the S&P 500 has made about 1% a year less, I believe, if I recall, than the equal weight, the cap weighted made about 1% a year less than the equal weighted. Now, let's go back to the idea that if we could make an extra 1%, that could give us an extra $3.5 million over that lifetime of saving and taking money out. And so I would say that would theoretically be a slam dunk, but it isn't. And the reason it isn't is because when you go and look at the returns over the last decade of the equal weighted, it's about a half of the return of the equal weighted. The equal weighted is half of the cap weighted. And so people say, well, why would I want to invest in the one that hasn't been doing well recently? Well, because the whatever period of time that is, the 25 plus years, no, 45 years, I guess it would be. Over that 45 years, the equal weighted did a lot better. And by the way, uh, we have a fund that started about the or that you could look at that for the S&P 500 going back to 1976 when it started. If you took a large cap value fund that was around since then, the large cap value fund has outperformed the S&P 500 at the same time as it charges over twice as much to have it managed. And if you looked at the history of the two, at almost all times since 1976, almost all of that period of time, it did better than the S&P 500. Sometimes by a factor of 2 times. I'm talking about 2 times as much money. If the S&P made 10,000, then the other one made 20,000. So there's lots of evidence, but the evidence that we look at is long term. And again, most people think what's happened recently is more important. And when you start thinking that way, I want you to remember back to 1999. The market for 25 years, the S&P 500, had compounded at 17.2%. And when people were surveyed, people thought in the future the market was going to do very well. And in fact, for the next decade, it compounded at a negative 1% a year. So it's just very hard to meet your desires. The market just doesn't care about your conclusions or your needs or your wants. But if you get your money in there and let it ride, let it go, but have it diversified, your odds of success historically are very, very high, unless, of course, you put it in the Belgium stock market. I mean, that's the thing we have to worry about is we don't diversify across countries. And I want to add one more to that, Jack. In Japan, in the late 80s,
Yeah.
The world thought, well, I mean, their high-tech industries had done even better than our high-tech industries. They were on a tear, and the market went sky high. Not only did it go sky high for the stock market, but so did the real estate market. And then it came crashing down for decades and decades, and really hasn't yet to recover in most cases where it was at that time. So that could even happen to the U.S. I know people won't believe that, but home bias is one of those biases. There are about 48 different biases that we have. And home bias, we think our kids are smarter than other kids. We think we personally are smarter than other people are. We think we're better drivers. We think we're overconfident about who we are and our family and our neighbors or the city we live in. So people in Greece are more likely to invest in companies in Greece, same with New Zealand, than they are in the U.S. And of course, there are people in the U.S. right now, and this is in the first time in my life anyhow, but people in the U.S. now are concerned about the future of the U.S. And I've talked to people who are leaving the country. Well, could it be? Of course it could be. That actually tends to be, there's more evidence of that happening, of a country failing, than there is of evidence of a country not ever failing. So if you want to look at the evidence, it looks to me like diversification, and I've got half my money in internationals. And it's not because I have any belief about internationals doing better. but that's what the academics have taught me, and I buy it. On the other hand, I think it's important to understand that doesn't mean I'll make more money, because internationals have underperformed sometimes, outperformed others. Over the last 55 years, the returns are about the same. In the 70s and 80s, the internationals in many cases did better. Japan was part of that, by the way. So it's easy, the things I want you to do, but you're going to have to put some of those biases aside.
By the way, in the end of the 80s, Japanese stock market was the biggest in the world. And then upon the crash, the United States, they became number one. So, of course, also, as I mentioned, highly developed countries like Belgium, Austria, Italy, they were underwater for decades, for 70, 80, 90 years. So that's also, I think, a good lesson we can learn from. And just going slowly to the end of this discussion, because I know you are already waiting for your nap. You woke up so early today, Paul. So I wanted to ask you about, because you are advocate for do-it-yourself investing, but when should be maybe someone consider getting professional help? I mean, how can they identify that it's the moment that they need a competent advisor who can lead them astray?
You know, that is a great question. And the fact is, I think if a parent or a grandparent wants to do something that would really be good for a child or a grandchild, and they are entering the workforce and making some big decisions about investing, to give them an hour or two with a professional hourly investment advisor could be one of the greatest gifts you'll ever give them. I'm not talking about somebody who they're going to be is going to become their manager for life. No, the purpose of that meeting is to get that hourly advisor to help that young person do the right thing within that 401k. As a matter of fact, it's when they've taken that job and they have a 401k that would be perfect timing to go through that process. I think everybody at some point in their life should spend time with a professional advisor. I think many people who cannot face pulling the trigger themselves will probably need a professional advisor to do everything for them, even though they could be taught. Most doctors do not operate on their family members. And in some ways, it's for the same reason. Your money is really important to you. And oftentimes, it's more important to you than almost everything else in your life. Because when I say your money, how you make it, how you spend it, how you use it to entertain others, I mean, it's just so integral to how we live, and how we live later in life is about money. So I am an advocate for everybody, particularly the first time investor, and also I would say maybe 5 years after that, it would be good to have another hour of some of the same to see how you're doing, and maybe take a look at some of the budgeting that people may have done. There's so many budgeting uh, uh, calculators now that there's no excuse not to at least try to do that. But then, if you were probably within 10 years of retirement, hourly, get some hourly help. And because there's so many things you may not be taking into consideration, there are ways that you can save extra money during those final years of work. And you may want to be figuring out if you need to do that. You also need to put a glide path in place. You need to figure out, when do I start adding fixed income, and how do I increase that as I get older? My wife and I are 50-50 stocks and bonds. I'm almost 82. And that's appropriate for who we are in our financial life and what we're trying to do for others. I'm trying to leave a bunch of money to Western Washington University to underwrite the Merriman Financial Literacy Program on that campus. So I have lots of reasons to die with more than I need. And I've got a spouse that will probably outlive me. All those things are important. But the bottom line is 10 years and then right before you retire. Just to check. I'm not talking about somebody taking over your money. Somebody to sit down and check with somebody who does this for a living. Now, on my podcast, and maybe sometime you should do this too, Jack, on my podcast in the next months, I'm going to probably have, and I don't interview others very often, but I'm going to interview 5, not all at once, but separate time. I'm going to find 5 different kinds of hourly advisors and interview them so people can get a sense of what those folks can do for you. And there is nobody that I know that works so hard for so little in this industry as the hourly advisor. And if you are an assets under management advisor, as our firm was, and most are, you can build a fairly big company and gather a lot of income from it. On the other hand, when you are billing by the hour, and most of the hourly people do not want to work in an environment where there are a whole bunch of people hanging around whipping folks to work harder. They work for a very reasonable fee, and as far as I'm concerned, doctors, I think, as a group, are fairly financially oriented. Teachers are not. I look at the difference between, for example, a doctor and a nurse. When we did the kinds of folks to hire, the character that we wanted, the type of personality, we were not looking for people who were trying to make lots of money. We were looking for people who were like nurses. You want people that really care about changing people's lives and not watching their watch because they only have 20 minutes for an appointment. And so I think that hourly advisor is a really big deal. And with AI, with artificial intelligence, I will be replaced easily with artificial intelligence because there will be artificial intelligence that will teach everything that I'm teaching. In fact, I want to get it set up so that when I die, that if people want to access me, they can access it through artificial intelligence. But the bottom line is sitting down with somebody who will walk through all of those things, all of the emotions that need to be gone through about getting started and putting saving above spending. And I mean that in the Warren Buffett way. This is my favorite Warren Buffett quote, and that is, don't save what's left over after spending, but spend what is left over after saving. Studies have tracked that belief and acting that way. And the people who have learned to save, have that money come out of their salary before they have a chance to do anything with it. Those people are way ahead on the saving and investing process in getting ready for retirement. And for more and more people living longer and longer and wanting to retire sooner and sooner. It seems to me if we can figure out some way to get there, which means saving likely and investing, not just saving, but saving and investing in your best interest.
Paul, I promise it's the last question from my side for today.
Okay.
I wanted to ask about staying the course because we can talk about all these things, but in the end, someone needs to execute the plan. So I wanted to ask, what's your best advice for beginners who will inevitably face market downturns and the temptation to abandon their investment plan. So how to stay the course?
Well, I think the answer is that 30,000 feet. It's automate everything. Automate. As I mentioned earlier, index funds are a form of automation. Dollar cost averaging, a form of automation. Putting money into a 401k as you dollar cost average is a form of automation. What do I like about that automation? The automation with just those three things would mean that you would have lots of diversification, more than likely. It would also mean you would have low expenses if you shopped carefully. It also means that when the market is down, you will be automatically investing in those companies that are in those index funds. And then if you keep your hands off it and don't market time, for crying out loud, don't decide to become a market timer and second guess the market. If you have automated your investment so that at age 40, you start adding some fixed income. At age 45, you add a little bit more. As you get closer and closer to retirement, let's call it at age 65 or 60 or 70, you want to have probably 40%, maybe 30%, maybe 50%, depending on how conservative you are in fixed income. Preparing yourself for the fact that, yes, sometimes the market goes down, but not sitting there like a sucker and letting the market take half of your money. And a lot of people, when they get to retirement, they keep going equities all the time. And those people better have lots of money saved. But you just figure it out up front. And again, I want you to become your own investment advisor, which means you probably need to read some books. And as Jack mentioned, we have the truth tellers on our website. These are people, I don't get a penny from them for being on our website. But if you got to know their teachings, Jim Dolly runs a website called The White Coat Investor. It is for doctors and dentists and hopefully some nurses as well. But the fact is, it's for every one of us, because what he is talking about and teaching, and so beautifully, are the ways that you save and the ways that you invest. And he's not getting a commission for you to buy something, a stock or an ETF or a fund from him. Now, there are other things you can pay him for that you don't have to. I've never spent a penny on his site. But he does a marvelous work. But you need to translate what he teaches into who you are and where you are in your life. And I don't care if you've only got a little or you've got a lot. It's still a matter of percentages. Because remember, you put the $100 to get started into an ETF or a regular mutual fund, and the person who puts $1 million in has exactly the same percentage ownership of every security. They just happen to have a lot more in it. So I hope you'll use our work and I certainly, by the way, I want to say thank you, Jack, for inviting me. But more than that, congratulations on having taken your project where it is today. It feels like it's about to take off, and I'm really happy for you, and I'm thrilled to be a part of it. So thank you. I hope you'll have me back.
Thank you, Paul. I'd like to have you again on my show, definitely. And thank you so much for sharing these crucial insights about, avoiding these all investment mistakes. And I know that your commitment to financial education through the Merriman Financial Education Foundation is truly making a difference. So The biggest mistakes are often, the most avoidable ones. And I hope that today's discussion will help people to avoid them, like, starting too late, paying too much in fees, chasing performance, trusting the wrong sources. So you can go and visit on Paul's website, The Truth Tellers. By the way, all the links will be in the show notes, so you will not miss anything.
And let me tell you something, a link that I know you'll have, Jack, but I want to, if I may. The book, We're Talking Millions, 12 Ways to Supercharge Your Retirement. A second one called Two Funds for Life. A third one called Spending Your Way to Wealth. We have 3 directors in our nonprofit. They each wrote a book. I was one of them. They're all free as downloads. And let me just say, even if you don't want to learn about all the psychological ways, how to manage the psychological hurdles, in that book about spending your way to wealth, at the back of the book, there's a list of 46, I think it is, biases we have that all impact us when it comes to money, not just investing, but money. And to know that those are the biases that are running around inside of your head. And there is an industry, we call them Wall Street here in this country. They know all about those biases. They know them well, and they know how to address them to help you overcome them and land on their side of the field. And what I hope that you will do is you will understand those biases and figure out how you can make sure you land on the other side of the field, where the probabilities for your long-term success, the final score for your team, your family, should be so much higher than if you had ended up on the other side of that field. Thank you. And thank you, Jack.
Thank you again, Paul, for the time and wisdom. And thank you also to our listeners for joining us on ETF Atlas. Until next time, and keep investing wisely.